Hey Larry, it's time for your presentation.
Awesome. Let's go, Joe. Teach some folks about taxes and saving some money. This is pretty fairly quickly. So, it went up a little bit. These things are tied to inflation. Health savings account is tied to inflation. So alternative minimum tax, not very many people are subject to that anymore. Has to people a lot of long-term gains. So there's not a lot of that going on at the moment, but they did give us a little bit more room in the alt min, so it should exclude more people. Kitty tax, people that have kids that have some savings accounts, it's not a lot of them. Health savings accounts up to 7,000. Medical savings accounts, and so medical savings accounts are a little bit different. So these are a little bit different than we've had in the past. I don't know if anybody, they've opened up some of these opportunity for these individual types of coverages. So MSA is starting to be a little bit more popular. People are familiar with HSA, but MSA is just a little bit different. So it's another way to have another deduction, okay, that doesn't go through the Schedule A, hopefully, like the SSA, the HSA is on the front. So a good news, the AGI limit for medical has been permanently left at 7.5%. So if you were over 65, it was 7.5%. If you were younger, it was 10% for a couple of years, but it looks like they're going to leave it at the standard 7.5%. So if you have $20,000 of medical expenses out of pocket, 20,000 times 0.075, so $1,500 of them won't count. It's 7.5% of your AGI. So whatever your AGI is, if your AGI is $100,000, the first $7,500 won't count. It's eligible long-term care. There's some new credits for this or deductions for this that can count if people have as early as 40 years old. So in here, I think it's long-term, as early as 40 years old. So it's not much, but if you have the plans, it's one more thing that we have to ask for. Not a big deal, but just one more thing. Most of the time, people don't tell us if they have long-term care plans unless the businesses are paying for it. Okay, there's the miles. Gas is down. So in 2021, it's down from 57.5. So it's 56 cents in 2021 miles, and there's charity. Okay, medical taxes. Foreign earned income went up for those who work out of the country. Dividends, the rates, the percentages are all the same. The percentages for the longest 0, 15, and 20%, just how it has. But what they did was it from 0 to 80,000 is a joint, and then it used to be like up to 320 was 15%. Well, now the 15% bracket is I want to say up to 500 grand now or something long term. So here it is. Yeah. So in the old days, what would happen is if your overall income is less than $80,000 and you made $60,000 in the market, you would have been taxed all of it at 0. Okay. And then over $80,000, any long-term gains would be taxed at 15. And last year, I think it was 320, but now it's 501,000 for married. So you got a bigger 15% bracket before you get into 20%. So for the most part, it's 0 and 15% for people. The state is staying the same, $11 million. That's a combined estate, husband and wife. And then the exclusion is still $15,000. So you can gift anybody $15,000 once a year, as much as you want. So adoption credit, that's up. Oh, these are, so let's make sure I understand the difference. So the things we were talking before were deductions. So if your tax rate is 30% and you got a deduction for $100, you saved $30, 30%. Today, this one here is credits. These are dollar for dollar. So a $14,000 credit for somebody who's in the 30% tax bracket is somewhere in the 20, yeah. Oh, that's tax, yeah. It's somewhere around 34, somewhere around $48,000 worth of income. So this tax right here covers like $48,000 worth of income. So anyway, this number's big. We're still getting the child tax credit for kids under 17. Earned income tax credit, not many people get that. Child dependent care, some people are getting that. American Opportunity tax credit. The lifetime learning credit went away. So people with kids just going to college aren't going to be able to, there's a way that we used to be able to cheat and get a fifth year, a partial fifth year out of using the lifetime learning credit, because colleges start in the fall and go to the spring. So there's always 5 tax years where there's only 4 opportunity tax credits allowed. So anyway, so that's not good. But anyway, student loan interest, the same as before. Okay. Retirement plans, 401ks are $19,000 if you're under 55, and that stays the same. And then the step up for over 55 is the same. They didn't change. The reason these don't change, and sometimes they do change, is because the formula actually says, to round to the nearest $500. And that's what these say. So when some things change, like here, the max wages on retirement plans went from $290 from $285. These are the max wages you need in order to get for certain cash balance plans. Depending on the type of plan it is, you'll need to reach these maximum wage numbers. And they're all tied to inflation. Every single one of them is tied to inflation now. The problem is people don't understand it because they say, but this one didn't change. It didn't change just because the rounding still rounded to 19.5. So all of these numbers change every year. So just understand that. Simple plans stay the same. So there's one other thing that's been extended. So if you have young people that are making fairly nominal amounts of money, or these kind of amounts of money, and they're single, they can get a saver's credit, which is a tax credit for putting money in, and it's a percentage. So it's pretty good. It's pretty good deal to do if they put money into their 401ks or anything. So they're trying to encourage, the federal government is doing nothing but they're giving these credits for one reason only. They want people to put their money into these vehicles for the future. So they're really encouraging those. Okay, so those are just highlights of some of the changes. Now, I'm going to go through a couple more things just real quickly. And these are kind of the business and COVID related items. So number one, we're getting there's a lot of theft out there. People should know about their transcript. It's very easy. Go to irs.gov and remember all of the addresses you lived in for the last 50 years. And if you can remember all your addresses, you can answer all the questions. So they just go through a bunch of questions. Once they have your access to it, you can see all of your information. It's similar to filling out a 4506T or 4506TZ when you're doing a new house or filling that document out. So Now, also there's one update. So on 4506Ts, if you get these, they're going to create this 10-digit number, which is probably a 1 and your social or something is what people are guessing. I don't know what they're going to do. And I don't know if they want to use, I don't know. I don't know what the rules are. My point is that they're going to start requesting more diligence on the taxpayer to remember one more number in their life. Okay. And so we went in and got our transcripts. The other thing related to that is you can go to the ssa.gov and get your last 26 years or, all your history of all of your work. So all of those are working very well now. Okay. Business tax. So these are any kind of business, sole prop, S corp, C corp, whatever. So the standard miles for you guys has changed. Standard, so section 179, accelerated depreciation, has increased from 25,000 to 26,200. That's the limit on the SUV. Remember, the pickup truck with a bed could be fully deductible. We don't even use this 179 very much because we're still allowed to use bonus depreciation at 100% through 2022. So a lot of people are very unfamiliar with this. And what I mean by that is we as accountants have been using this little tool since 2018 to write off things that clients thought we were actually using section 179 to use. We didn't have to, so we did it. We used the bonus depreciation rules. Partly we did is because although both of them have the same kind of recapture rules if you sell it early, we knew bonus was going to expire at some time. So for the most parts, we use bonus depreciation as much as we can, and then we move to section 179. And this is normally over plus $1 million in purchases, So guys are buying couple $1 million worth of stuff every year. For the rest of us, Section 179 should still pretty much solve most all of our problems. But just as a note, bonus depreciation is finally phasing out according to the laws. This was the original law that was out there. And so bonus was only to help people catch up on depreciation on early purchases. So you make $100,000 in the stock market, you wanted to go buy a $300,000 house, you put a rental house on it. You put $100,000 down. You want to try to get $100,000 worth of deductions out of that rental house using various depreciation rules, which we couldn't do for many, many years in the rent. Today, in the new rules, we can use just about any asset to glean out deductions when we have profits. Although I think a lot of people are not going to make money, and I'll explain some of that later. Not as much profit. Anyway. QBI, that's 20% of your K1. That's for your S corps, partnerships. We have a new reg on this that is going to get people a little bit confused, and we need to do more research and ask our clients. What I'm saying is S corps and partnerships are not created equal. S corps, according to the law today, do not or do pay tax. They do have their self-employment taxes double taken out of the QBI calculation. So I've taken a class on it. Most of this is how this is exactly what the IRS told the software companies to do. It's exactly how my software is built. It's exactly it. So on my S corp, if I had been a partnership, I would have been able to get $10,000, $12,000 more dollars towards QBI, 20% of $12,000. $2,400 deduction, at 30%. So I basically, according to the class I took, screwed myself out of $720 last year. The way that I did my S corp, the way that I allowed the QBI calculation on the personal part of the return to take out self-employment or to reduce QBI by self-employment again, because they're using the way the calculation is. I don't know that I'm going to do that for 2020. I'm talking about my 2019 return. 2020, the software is built the same. We're waiting on the IRS to be clearer, but simply what we need to do is somebody to have a bunch of guts and a lot of money they don't need and go sue the government and say, hey, idiots, you can't be stealing $720 from Larry because you say self-employment tax, which is already built in my K1 because I've already paid for it in my K1 and it reduced my K1 income. You can't bring it over to my personal and reduce it again because I'm an S corp. And that's what the software, and that's actually the formula that's built is doing. So anyway, clients that are an S corp, we will have a conversation, make a note of it, write on this. R&D credit, it's better this year. If you have any of that, you need to do some research on that. It's better. Okay, work opportunity credit. Work opportunity credit. So this is when you have somebody who's military or they were, I think, ex-convicts. So anyway, so there's a number of things like that. So the work opportunity credit, and it's 25 to 40% of what these people make. So it could be a fairly sizable number. We know we have some clients that have actually taken pretty good advantage of that. There's companies out there that will manage it for you. If you have a number of stores and places, you can outsource the activity. You just send them all the data. They put it all together. They do the calculation. So health employment insurance limit, that's like S corps. That's like us, me. So what this means is it comes through on my W-2 basically and shows up on the top of our 1040, and then I take it back out of the bottom of my 1040. So I tell the government exactly what my insurance was for the year so they can track me. But that's how the S corp process works. This year the limit's 27.8, which is, if you have it like we do, that's about what you spend. Those family. Okay, so meals entertainment. We finally have a real touchdown for people that might be on this call who really eat out a lot with lots of clients and sales. So in 2018 and before, meals, entertainment were 50% deductible. After 2018, entertainment has been zero. So the real entertainment, the football tickets, this has been zero. The meals were dropped to 50%. Okay. We still think that the entertainment piece is zero, but in 2021 and 2022, it's 100% deductible as long as the meal was at a restaurant, provided by a restaurant. So right now we think the entertainment we still think that this is zero, meaning I don't think football tickets work, hockey tickets, I don't think that still works. But what they have done is where meals were 50% in 21 and 22, they've gone all the way up to 100% as long as it's from a restaurant. So that's probably one of the better things that have happened. So we've got clients that got $20,000 or $30,000 of meals and entertainment. We got to sit down and break it down. What's really entertainment? What's just really meals? How much is how much is a client? So we break down entertainment now, and you can look it up as basically like football tickets. Whereas if you go to a football game, the ticket's not deductible, but the $200 hot dogs and beer is deductible, 100%. So anyway, because it's a restaurant that you're buying that stuff from. So anyway, Fringe benefits, not many people in Dallas travel, but that's been put back in there. That was being knocked about some. If anybody of your client, in your staff or anybody has people that drive, come in on the bus, come in on transportation, you can give them this money tax free. It's just, you just give them to them like a mileage allowance. So, and it's not taxable to them, and that's a couple $1,000s. Okay, ID theft. That is a big deal. People really need to pay attention to the ID theft. It is not going away, and so now almost anybody can get a PIN. It used to be that you had to have proven theft or something. It's not hard. I think there's been a number of break-ins into Equifax and those kind of people over the years. But anyway, so now you can just apply for it. I think you apply for it online. If you're victimized, you still have to fill this form out and explain it all to them so they can chase the guys and see if they can't. They'll put it on the FBI website if they can figure out what happened. So that form is still required. Okay, I won't go through this very fast. I'll go through this very quickly. Credit reports, guys should read this. This is becoming more and more important. Interest rates are almost zero. What we want to do is make sure that everybody's locking in with long-term low rates for anything they're trying to do before they go back up to 18%, like people told me in the early 70s, which can't imagine it, but who knows? Someday they have to go from zero someplace because they can't go any lower than zero. So anyway, paying attention to the credit reports, very important. There's some information on that. Okay, so let's get to the meat of this. All right, so everybody knows. Yeah, I got everybody out of the waiting room. Okay. Yeah. Okay. There's three integrated actions that happen. There's basically the CARES Act 1, the CARES Act 2, and then the defense bill. Why does the defense bill matter? It did in a couple of places, but I didn't really mention it specifically. But there's three different laws that went into effect that generated all of this kind of stuff. So in 2020, when the first COVID Relief Act came in, there was $600, and a lot of people got that money. Excuse me, $1,200 the first time, apologize. $1,200, and it came in a various ways. If you made less, if your family is less than 75 or joint, 150,000. So a lot of people, so a lot of people got $1,200. Okay, so what were some of the tricks about it? Well, we found out that our kid in college who was kind of on their own didn't get any money because they were over 17, but they didn't file their own return. Okay, so there's a few things with 2020 that's similar when the $600 payout came about. Okay, but let me explain. In the 2020 return, if you didn't get either one of the monies and you're sitting there and waiting for it, there's a place on the 2020 return to simply tell them, I didn't get any of the money. You put it on there, they check. If they say you got the money, they send you a letter, say, hey, we put your money in your parents' account. Did you not know? I don't know what happens. It's happened to one of my kids. But so they'll verify it. They won't pay it back. What do I mean by that? If somebody comes to me and says, I don't know whether I got any of the money. I got divorced and it should have gone to a joint account and blah, 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 whatever. We may not care. Abdullah, can you hear me okay? Because I have my headset too. I meant to ask that. Sorry.
Hello?
Sure, you can it's everything here. So, no one's complaining necessarily. Okay. But so on the return, if somebody's not sure and they say, I didn't get it, they put it on there, the government's not going to send them the money. The only people that really know what happens is the government. They know whether they released a check and they know whether it cashed or not cashed, or cleared or didn't clear. I think they can even look at the debit cards to see if the debit cards got spent. So anyway, so there's been a lot of questions about last year and they didn't get the money. 2020 return, you just say I didn't get a check at all, and you would actually you'd put $1,800 because you the $1,200 at the beginning of the year, and then the $600 at the end of the year. There is, and I'll go at the very end a little bit about the Biden plan. There is another $1,400 coming, but that will not be on the 2020 return. So make sure the other $1,400 they talked about isn't going to be on the 2020 return. It'll be on the 2021 return if it's anything. Okay. Unemployment benefits. Just recently they got re-extended. I know self-employed or small S corp people who called when their business was low and got unemployment benefits. It's just taxable. It's taxable income. So not a big deal. I don't think the government even really cares. They're going to charge tax on that money. For the teachers out there, you can use the educator expense on PPP, so everybody spends over that anyway. One of the things that's weird is this year, because so many people have given money to charity, and a lot of people don't qualify for an itemized deduction anymore because the itemization is what, $25,500 for married folks, and so you have to have quite a, and your property taxes are capped at 10 grand. So your mortgage interest has to at least be almost 15 grand just for you to get into the game of having it itemized. So anyway, if you don't itemize, you just have to remind us that you did give $300 to some charity at some point, sometime, somewhere. Not a big deal. We're figuring that most people have done this because of the pandemic. So it's above the line also, so it's a real deduction. And of course, there's a new thing on charity. So the people that do give a lot of charity, but actually are retired and only have limited income now, maybe part of their income is retirement, they could actually give away. In the old days, you could only give away about 60%. So if you made 100 grand and you gave away 100 grand in charity, we could only code 60,000 deduction this year. The other 40,000 would carry forward. This year, if you make 100 grand, you literally get to take 100 grand on the Schedule A and pretty much wipe out all of your income with charitable donations, charitable contributions if you want. So that's in 2021. Earned income, okay. Not many people get earned income credits. I get that. But if you know anybody that does, if you have anybody that you know does earn income credit, they can use, especially if they were somebody that had a restaurant position or something that they were up and down in income, they can actually use 19 or 20 income to qualify for the earned income credit. So they could use either one. Whichever one is better is the one that they should choose, because it's not always the highest and it's not always the lowest. There's a formula. It's a circle, of course. And so sometimes you look at it and say, yeah, I made a little bit less than 20, but my earned income credit would be less. So why don't I use my 19 and get a little bit more earned income credit? That's the formula. That's what they built. I don't know why. Okay. Okay, so next. All right. So I've been hearing a lot of people who said my business was down. I went ahead and took some money out of my 401k. Can I stand up and clap and say, thank you very much. Congratulations. If you had taken $100,000 out of your 401k last year, you're about to hit a home run. And let me explain why. Number one, let me stop at the very top. Flexible spending and client counts, which remember you lost, it's use or lose on all those. They've changed that rule for 20 to 21 and 21 to 22. If you have any flexible spending account, you can roll that over to the next year. That's a new change. Check with your employers. Make sure that that's kind of happening. Because I don't know that a lot of people are going to pay attention to that. And companies like mine, like we all, if you don't spend it, we used to keep that money. Then we used to get refunded that money. So nothing personal, but we prefer people not to spend it all. Okay, here's the big deal. If you had a 401k and you took out $100,000, you can pay tax on a third of it in 2020, a third of it in 2021, a third of it in 2022. So this means somewhere around 4/15, 2023, I'm liable to not live that long. Okay, I don't know. So anyway, so 4/15/23 is when I would pay tax on the last piece. But get this, let's say that just before my 36 months is up, because I put this $100,000 into an investment, I just put it into a CD, and guess what? It's $136,000 now, which it won't be in a CD, but say it was. Well, what I would do is I would say cash out, take my $100,000, go and put it back into my account. I would amend this, get my money back, and I would amend this, get my money back, and never pay tax on the $100,000. So that's a trick we've never seen before. So it's a great trick, and I've heard a lot of people have taken money out of their retirement accounts. My wife and I took money out of retirement accounts. We bought land with it. It is, allowed to do. This is what it's for. We are going to pay tax on this 1/3 of it this year. I'm going to pay tax on it one this year. And if I happen to sell this land before here, then I'm going to put it back and then amend these returns and never pay tax on that money that I took out of my 401k and didn't pay tax on it or put it back till sometime, 2020. You have 36 months from when you took the money out. So 12/20/20 gets you all the way to 12/20/23. To put it back. Kind of interesting, really cool. I believe the same kind of thing may happen for 2021. Okay, so we don't know exactly all the rules right now, but if we do, they didn't actually finalize this until like January 6th, right? So, okay, mouse. Let me see where I'm at. Okay, cool. Okay, I know there's a million questions about this stuff. We're going to go through the PPP program. This is going to take a few minutes. Go back down. Okay, yeah. So, and I'm gonna focus on a couple of things. The PPP program, there's two pieces. So those of you with small businesses like me who applied in PPP1 and got money, actually PPP1 is still open. Okay, I guess it's easiest to start at the top. Let me start with this. First and foremost, what everybody was having a fit about and was most concerned about was the IRS ruling that the expenses were not deductible. This was confirmed by Congress in the January 6th release. What that means is all of the payroll, all the utilities, all the stuff you spent the money on, it counts as a deduction, even though the IRS told us the deductions wouldn't be expensed. They also reconfirmed that the loans are actually tax exempt. Okay, what does that mean? That means once forgiven, you simply move that on your balance sheet from liability to, I called mine PPP loan. To equity. So I actually called it PP right here, equity, PPP loan, once it's forgiven. And that's under the equity section, just below the liability section. It never goes to the P&L. It's never income, even though I know I've had debates with dozens of customers over the last year who just can't believe it. I understand you can't believe it. I couldn't believe it either, but that's what I kept hearing. Okay, so let's talk about a little more detail about the PPP1. If you've not asked for forgiveness, then you might not want to yet, because there's 146 billion, I think is what I read. I think I read 146B old money. And if I want to remember right, the reason this number is so big is because all the big restaurant chains and the public companies gave back like $100 billion kind of after the fact. So a lot of money kind of went back in, but they ended up with a bunch of money from the old ones. So they would like to spend that. And if you would like to have it for free, you can. All you have to do is ask. So that's one thing. If you've not applied for your forgiveness on PPP1, you actually can go back to your bank and inquire and say, I did the math wrong. Instead of asking for 100 grand that I asked for and you gave me, I've done my forgiveness calculation. And when I realized my total wages were X and not Y, I could have asked for $126,000. And you simply say, will you please give me a car for free? And they say, yes, happy to. So if you have your open PPP loan, one loan, and you've not, you might want to go back to the well and ask for more money. Also, it cleared up this question of the EIDL loans. These were loans for the EIDL, the SBA. If you had revenue shortage, you could do an EIDL loan, and they would advance you $10,000, different amounts for different folks. We were told that this was going to be taxable, or it was going to be reduced from our PPP loan, which means it would be taxable because your PPP, you wouldn't have to be able to forgive as much. Okay, so that's not true. It's not taxable. It's all good. It's the best thing since sliced bread. The $10,000 if you got an advance isn't deductible. So if you got a $150,000 EIDL loan, then you should only have to pay back $140,000 at your 2.986% or whatever they hit us with over 30 years on this money. But you only pay tax on this. And of course, your banker has those details. My banker's just working out the specifics, and they're getting better at understanding what the rules are. The SBA is getting better at understanding what the rules should be. They were clarified in the last act. Okay. So here was the 2020 rules. 300 and less employees, 50% reduction of revenues quarter over quarter, 19 to 20. So these are basically what the rules were to qualify if you had a bad quarter. Now, and then if you didn't have as good a quarter, 2019. So that's just the 2020 versus 2019. Okay. Now the 2020 rules. Oh, I'm sorry. This was 100 or less. No, yeah, 303. Yeah. So this is now for 300, and you only need a 25% reduction, okay, over prior year to be able to qualify for the 2021 PPP rules, okay? So you need less loss reductions, year over year reductions to qualify in the rules. So they made the rules easier. In fact, the class I took basically says they took 62 or something questions that were questioned by the IRS, and they basically just told the IRS all that's good. You know, forget it, just leave it alone, because I don't think anybody could really agree. So PPP2, if you've got a reduction in revenues, you're going to potentially qualify for this, but you also need to pay attention, because one of the things I'm talking about in a second is the employee retention credit. When you first did a PPP loan 1, it's exclusively said if you do a PPP, you cannot get an employee retention credit. That has gone away. There's a lot of angst about that, and that's gone away. So we can actually double dip in the PPP and the earned income and the PPP and the the employee retention credit. We can do both, but just not on the same period of dollars, not for the same period of dollars. So if your PPP was for 8 weeks and it was for March and April, or for April and May, and you had people out in June, like we did with Gavin, who was sick, and we also moved people home, we can qualify for the employee retention credit, which I'm going to get into in a minute, which is different. But why you have to pay attention is when you fill this paperwork out, you need to pay attention to the periods of things that you're using, quarters in particular, wages. Okay. If you received a PP1 loan and realized it should have been larger, how do you know that? Well, when you fill out your paperwork, it asks you for all these questions, and then it does the math for you. It says, hey, is what you qualified, 192,000, bigger than we gave you, 150 grand? Oh, dang. Holy cow, I left 2 cars on the table. Whatever the math is. So that is what is critical in trying to understand about this PPP, especially for the ones who've had some struggles. So anyway, so let's see. If you got a PPP1 loan and paid it back, I don't think you can amend a PPP1. I think you could just go to PPP2. If you never got a PPP1 at all, you'll go to your banker and you'll do both. You'll ask for, here's what happened in the previous year based on 19, and I had a quarter that qualified in the first time, so I want to go ahead and qualify for this. Great. Now what do I qualify for the next year? Different periods, could be, I think we use the same quarters for the reductions, if you lose revenues. So anyway, there's going to be lots of restaurants, construction companies. There's even some rental properties. There's other, that didn't get paid because people weren't paying. So that could qualify. Okay. One of the other things from a cash flow perspective that's kind of interesting that's gone on is you can actually withhold 50% of the Social Security, the employer portion of the Social Security, not the employee portion of the Social Security, not the trust fund part of the Social Security. That's why they only allow you to keep half. But you literally can. So if your Social Security piece on your 941s every quarter, when you look at it, is $20,000, you could keep $10,000 a quarter, $40,000, and at the end of 2021, send them 20 grand, and at the end of 22, send them 20 grand. You just have to send them the money when the money's due. It's not taxable. It's just a cash flow method. There's lots of small businesses that were sort of taking advantage of this, and it's just how they fill out the 941. Yes, you have to pay it back. The problem why people did not take advantage of this early in 2020 was because the IRS said in CARES Act 1, we couldn't, that it all had to be paid back at the end of this year, at the end of 2020, excuse me, at the end of last year, like January 15th of this year, which means by the time people figured out they could do it, by the third or fourth quarter, it was already pretty much due. So they decided not to do it. So those people who haven't done their 941 for Q4 of last year, like we haven't, we're probably going to just keep that $10,000, and I'll give them $5,000 at the end of 21 and $5,000 at the end of 22, maybe, just to see. I might just do it to see how the program works, because I know a number of people out there are doing it. The system does it. The process is there. It tells you what it is. Another really good thing that's happened is these tax credits. These payroll tax credits have been extended through March of 21. Okay, for employees on leave and being paid. I'm going to read something real quick before I get into as I get into the employee retention credit, and we will find a way to get this out. So here's the basic rule, and here's the best little blurb that I found in a presentation that explains it. It talks about sick leave must be paid, okay? And when you can get an employee retention credit, okay? And when I explain this in a minute and tell you how much it's worth, you'll probably do what I do, which says I might need to look into this a little further. So, unable to work or telework due to a need for leave because of the following 6 things. Number 1, the employee is subject to a federal, state, or local quarantine or isolation order related to COVID-19. That's one of the rules that if that caused you to be closed, you're going to qualify to be in the game to look at these ERCs to see if you have any money. Number 2, the employee has been advised by a healthcare provider to self-quarantine due to concerns related to COVID-19. Yes, we sent Gavin home on Wednesday when he had a fever because we were afraid. He went and took a test on Sunday. We found out that's Thursday, Friday, Saturday, Sunday, 4 days later. We found out the following Saturday he had COVID. It took him 10 days. Now, we tried to take a computer home. He wasn't feeling well. He was trying to work some, but he wasn't overly efficient. He was definitely sent home because of concerns. Number 3, the employee is experiencing symptoms, COVID-19, seeking medical diagnosis. Gavin again. Thank you, Gavin. Number 4, the employee is caring for an individual who is subject to an order as described in paragraph 1. Do you have a child who didn't go to school? This is what number 4 says, and has been or has been advised as described in number 2. So are you caring for somebody who was at a school that was shut down? Or are you caring for somebody who was told by their school, go home for 2 days, 10 days, because you run a fever? You're going to qualify for this retention credit. Okay, I don't have much more time, but I go through this because it's important that people start asking questions if they qualify. Number 5, the employee is caring for a son or a daughter of such employee if the school or place of care of the son or daughter has been closed or the child care provider, such son or daughter, is unavailable due to COVID-19 precautions. Yes, the daycares and the schools were all shut down. So guess what? Number 5 says if I send Amber home for 2 months and she works from home and 30 of those days she's babysitting her 2-year-old and she's not efficient, I potentially could get a partial day credit of up to a maximum of $200 a day or $10,000 for an employee for the period. And I'll show you in 2021, it's $10,000 a quarter. So if you have people that are being paid or aren't overly efficient because they have children at home and they've got things going on, then there could be opportunities here. Number 6, the employee is experiencing any other substantially similar conditions specified by the Secretary of Health, blah, blah, blah. 6 is a catch-all. It's basically wording that says almost everybody in my company, except for my friend Leanne, who lives so far outside of the country, they don't even know what COVID is. Those are the only people that really aren't covered by this order. And now let me explain very quickly what it means. So let's say April and May, you had a PPP loan and it covered your April and May salaries and your rent and all this other stuff. But in June, July, August, September, October, November, December, January, February, March of 2021, I'm sending people home because we're up and down. We have offices in Richardson. We've had to, so follow me carefully. Renee worked from home yesterday, went home yesterday, didn't come in yesterday. She thinks she had food poisoning. We have to look at all that very carefully because if she was at home and I still pay her some money, I could actually get a credit for all of her money up to a limit. So it's important because the dollars can be huge. We're talking about this is per person. So in 2021, 2020, if you had a person who makes $20,000 a month and couldn't work, or $12,000 a month and couldn't work, and you still continue to pay them, you could get up to $5,000 for the year as a tax credit. Again, this means this tax credit is like making $25,000 or $30,000, $20,000, because this is actually a tax credit. You put that on your 941, and instead of your 941 saying, hey, send in 20 grand this quarter, it says send in 0 this quarter, or nothing this quarter and nothing next quarter if your credit's big enough. So anyway, so one of the things that happened for 2021 is they've reduced the quarter over quarter requirement. So a lot more people are going to qualify for retention credit. So in our office, we built a template trying to break down the year and doing some other things. But it's going to be fairly complicated. So you have to get all your employees, how many days a month they were out, how many hours, things like that. But if it became, I've got 15 employees, if 7 of them were out part of the time, and I got, 6,000 or 7,000 for the high end, or 5,000 for 2 of them on the high end, and 2,000 or 3,000 on the low end for 4 or 5, 6 other people, and it came to $20,000. That might be a couple of months worth of your 941 payments. You just simply don't make them. So really have to look hard at the employee retention credit and potentially any of the holdback if people are looking to cash flow, hoard cash, or refinance things. Here's a couple of other just comments on it. There's some quasi-governmental agencies who are completely excluded out of the first one. Those have been included. There's safe harbors that are allowing the employers to use the prior gross receipts. So we can look at 19, we can look at 20, we can look at 21, we can look at different years, and we can try to decide which one's the best. New employers can also claim a credit. How do you get a credit if you can't prove that your revenues are down 20%? That's a great question. Thank you, IRS. So we have a couple of new clients who are saying, I started up last year. I'd like to figure that out. We're just going to have to spend some time to figure out how we get them free money. Okay? Even doctors like free money. Okay. For one thing, when we get the tax credit back, people will ask, and when you look at the form and you actually fill out the form, there's 2 questions. One says, did you tell your staff you stole their money? And the second one said, it says, I certify that I did tell my staff that I kept their Social Security and Medicare, And the other one says, I did not tell my staff that I kept their Social Security and Medicare. We're going to mark that we tell our staff that we're going to keep their Social Security and Medicare. I'm literally getting a credit back for the dollars I paid them, 100% of their dollars. So if they made $120 that day, and I take half of it, that's $60. They actually only got paid 60 times 0.9265. They only got paid because I kept 7.65%, but I'm actually going to get $60. I'm actually going to give them the $11 back. And we're just going to do it in the form of a bonus. So it's not hard. When it comes back in, it's just sitting there. You know how much it is, and you just say, you either have to tell all your employees you're going to do it. You have to sign one of those two and attest to it. And it's for any employee missing time after 3/13/2020, all the way up until March 30th right now of 2021, even through this quarter that I understand. Also, this deferral of your payroll tax, if you want to hang on to that. Let's go here. Okay. Now, I'm going to plow through this very quickly too, and then I'll take some questions. This is for people who sold something last year or within the first 180 days, sold something. Let me read this. This is called a QOF, or a Qualified Opportunity Fund. What this is, here's the price of admission. The only way to receive benefits from a QOF: you must have eligible gains in the preceding 180 days from the date that you invest. A qualifying investment is limited to the amount of the eligible gains. Okay? Only get a QOF benefits to the extent of the eligible gain in qualifying investment. Let me explain. So, and I've got an example down there. So an example from this class I took. They have a local tenant. It's a piece of property, apartment complex in an opportunity zone. They meet. There's a couple of tests to meet. Do I have that on the next page? So these dates of when you purchase, you get these exclusions depending on when you sell the property outside of the Qualified Opportunity Fund. Okay? So a Qualified Opportunity Fund, and you can find these all over the internet. You take profits from any kind of sale that are less than 180 days old. So I have an example of buying Tesla stock for $1,000, sold it for $101,000, sold it for $100,000, so have $100,000 in profit. Okay? Normally you would pay $20,000 in taxes on it. He doesn't want to pay any taxes in this year. He's going to invest it all in a QOF. He's going to put it in $100,000 into a partnership that he created that he added another $300,000 to, and he bought a rental piece of property inside a Qualified Opportunity Zone. Okay? You can look them up. They're all over the place. Normally in areas they want you to invest in long term. Okay, so follow me carefully. So you make this investment, you don't pay the 20 grand. So if you hold it for 5 years, you're going to pay tax on only $90,000. Okay? If you hold that investment, and I'll explain it a little bit different in this other class I took, a little bit different way. Maybe it makes a little more sense. But so, and they're based on some dates in a second. You hold it, basically, you get a 10% reduction of your income tax-free. You hold it for 7 years, you get a 15% reduction on the income you make. You're only going to pay tax on 85 grand, even though you have $100,000. This is the kicker. If you hold the whole thing for more than 10 years, there's no tax at all if you do it right. So you take your 100 grand. So here's what'll happen. On the 100 grand, you invested into a co-op using Form 8915. You elect to defer. There's no gain in 2020. You own it until 2031-26. You have to pay tax on 90% on $90,000 in 2026. You still haven't got out of the investment. You've not got out of the investment. You've not gotten out of the investment. Why? Because if you just hold it for 5 more years and sell it for $1.1 million, there's no tax on anything. You put $1.1 million tax-free in your pocket. Hello? They don't make much better money than that. So that is the key to the QOF and understanding the QOF. Now let me go through some dates because these are what makes sense. You have time for this guy. You do not have time for this guy. The reason is because you had to actually invest in the QOF. You had to actually purchase your QOF 3 weeks ago. So these are for people, and then here's for purchases between here, okay? And that you get, these are your reductions. So if you purchase in between here, you're not going to get any reduction if you hold it less than 5 years. You're not going to get any tax savings. You're not going to save 10%. But when you, in fact, hold it for 10 years, you still will be able to get the 10-year benefit for that. But you have to, basically you get a 5-year deferral. I'm paying the tax. Let me go back over. It's kind of crazy. Instead of doing a like-kind exchange, you do an 8915 deferral. You don't pay tax on the 20 grand that you owe today. You wait till the end of 2026. Instead of paying 20 grand in 2026, you pay tax on 90%. So you pay $18,000 instead of 20. If you hold it until here, until the very end, and you beat the 10-year, don't sell that property, you beat it, the whole thing, from my understanding, and may there be more clarifications and lawsuits because we got a long time to wait for 10 years, that the whole thing is tax-free, including the original $100,000, which means you have to go back here and ask for an amendment. Amended return for 2026, or do you get the 18 grand back someplace else? There's some questions, no doubt about this. That's why I'm posting some of this. I'm going to post this on, I'm going to post some of this on my website so people can look at it, because things will continue to change, just like they did in the PPP loans from the first time when we told you couldn't have certain things like an employee retention credit. Okay, last thing, and then we'll spend 15-30 minutes asking questions. Okay, so accounting method. This is very important. There's a new rule. The old rule was if you had inventory, you're accrual basis. Lots of people are accrual basis. I'm accrual basis. I chose to be accrual basis. I chose to be accrual basis because in the early stages, because of the way we do business, I wanted to have more consistent early on income. So I chose to record my revenues on accrual basis instead of on a cash basis, because we lag at about 53 days sales outstanding. And because in the early days, we have lots of expenses, and I'm an accountant, and so that's how I wanted to do it. So are my restaurants, and so are the little beer and wine stores, and all these other people. They're accrual, but not because they really want to be. They're accrual because they have inventory. Okay? Some have very little inventory. But here's what the new definition is. The new definition of small business is anything less than $26 million a year in gross receipts. Gross receipts, total sales, not income. But if you have gross receipts less than 26 million, you can be a small business. That means you can be cash basis if you want. Okay? What does that mean to small businesses that have this choice to make? Okay? I'll do an example. The answer goes on form 3115, and I'm going to do two examples. I'm going to do the small business counting change for the beer and wine store, and then I'm going to do an example of a residential, residential real estate transaction. Okay, so here it is. Here's normal sales, net profit. They're going to split this, two guys, split this 200 grand. Each of them makes 100 grand. They pay their 25%. They owe 25 grand on it. And then they call and say, but what if we decide to be cash basis? Well, we need to write off your inventory. And they go, huh? We need to write off my inventory. It's foreign. They don't understand. I get it. Yes, sir. What I'm telling you is we're going to write off your inventory. What are we going to do with the inventory? Oh, we're going to leave it on the shelf. You're going to sell it. But from now on, your COGS are also going to be your purchases. Just like in micro small businesses. Purchases equal cost of goods sold in small, super small businesses. Very common. So, in this particular case, over here, remember you had 500 grand in gross profit. Well, this year, you're only going to have $100,000 in gross profit. Remember, you have the same amount of cash. You paid for the inventory 27 years ago when you bought the business. You've been waiting for a deduction for 27 years on this money. The government finally released it to you because they realized it's a game. You actually put this inventory in years and years and years, and you never get it back until the very end. And they're saying, time out. Let's get back to something that's not quite so crazy. So what they're saying simply is if you're small, then you are clearly allowed to be cash basis. So what this happened? Well, now they each got a loss of 100 grand. Well, they go, but what? I don't even want the $100,000 loss. I only made $50,000 in wages. Well, great. Why don't we carry it back to 2017 when your tax rate was 39.6, and we'll take that $100,000 back then when you made 400 grand in 2017, and we'll take that $100,000 and we'll get you $39,600 for that $100,000 that you're going to take right here. At that point in time, people start saying touchdown. They're going, this doesn't really make any sense. Completely agree. Completely agree. Completely agree. Doesn't make any sense. Give you another example. I own a building many people have been in. When I first bought the building in 2011, I only broke it down between land and building. Building is 39-year property. Land is not depreciable at all. You cannot get a deduction for land at all. So if you take $100 and $20 for land, and you never get to depreciate for this, and this is over 39 years, per year you get very little. Okay? And you have to live, for me, I have to live to 123 to get it all. Just kidding. It's a joke. So anyway, so it doesn't make a lot of sense. So what they did this year is they said, if you did that, you could use this same form, 3115, and basically it's the same form we use from accrual to cash. And basically what we can go in and do is go back and recalculate the depreciation that I could have taken on things like personal property, the windows, the HVAC, the the toilets, the stalls, the doors, all of that is considered personal property. So instead of the building being broken down, 20 that I'm going to get 0, 100 I'm going to get it over 39. I now came back and said, well, really, the land, building, and personal property, the land was really only worth $10,000. I overcalculated it. It shouldn't be this much. It should only be 10. The building was only $70, and the personal property was $20. And this would have happened in the year of purchase in 2011. Well, if I take that all the way forward to 2020, this number would be fully depreciated in that period because it's only 5 and 7 year property. So what is this saying? It's saying, Larry, please go take an extra $20,000 deduction this year. That is nothing more than a deduction I would take when I'm 123 years old. Of course I want that deduction this year. Why wouldn't I? So I'm going to go and break it out. So here's an example. Very simple, $1.2 million building. Now depreciation, this is 900 grand over 29 years. I'm going back, I figured out my PPP money in this example was 300 grand. My adjustment is $300,000, which means this year I get an additional $300,000 K1 deduction on my K1. This is going to be split. This I could take on this year's K1 as an additional deduction of $300,000 and only depreciate this going forward till I'm 120 years old, whatever. And I can carry it back to a year in which I had. So this is something for the people who own, restaurants and hotels. They own land and building that were not aggressive in the day that they bought them. They weren't aggressive because some years we didn't need to be aggressive. The rules didn't allow us to be aggressive in 2011. They just weren't there. These are really changed rules that came from the COVID Relief Act that allow us some tools to go back and adjust these things and take them back as far as 5 years. So, okay, not bad, 20 minutes. Quick summary, stimulus money, unemployment, charity above the line, earned income, all new, withdrawals for 2020. We don't know about 2021 yet, but if you took money last year, make sure that you make a decision whether you want to pay tax on it over 3 years or not. I'm assuming most will, but they have to remember next year that if they spend all the money, they got to pay tax on it. So be careful. PPP2 now is a 25% reduction. Earned income employee retention credit went from a 50% reduction of revenues to 20% reduction of revenues. So more people qualified for the employee retention. And this is literally getting money for someone who's full-time, who's watching their kid at home, who can't get work done 8 full hours. The Qualified Opportunity Fund and the change in accounting method are all very strange and different. Yeah, questions? Okay, so let me, so people can, everyone can, can type messages, or if you have a specific question, I see, okay, gifts from foreign companies don't, that's a whole different world. Yeah, sorry. Yeah, that's a completely different world. Generally, if they're not U.S. citizens, there's no limit. So I can give you my address. You can have them mail it to my house if they like to. So there's really no limit. If they're U.S. citizens, then there's a difference. Or if they've been a resident alien, there's all kinds of rules. But anyway, okay. If there's any questions, I can try to take, a couple. There's a lot of information there. It may be better. Some people call and ask and say, hey, I've got some questions specifically about some of this. In here are some more specifics about some of them, and this is on our website. And it talks about, there's more kind of specifics, details, but it all says pretty much the same as we went through. But here's some applications. So a lot of these from people that have been asking. Also, we put it on our website. So if there's any questions, Abdul, anybody, if you got any questions, then I know it's a lot of information. Everybody has these, so they can always specifically ask a specific question in email to us. AB? Okay, good questions. Very good questions. How do you document inventory for your bank? That's a fabulous question, and I have an unanswered. Sorry. So yeah, so here's the answer that we think the answer is. We think that the answer is you have to keep count of your inventory so that you can tell your banker, that you can tell your banker. Oh, okay. Good. You're good. I'll just make sure. AB. Okay, I didn't need to re-mute you. I didn't need to. So okay. So yeah, those are good. So we think we have to tell the bank what our inventory is, but we believe we don't actually put it on our balance sheet, which is the weirdest thing that I've heard from a guy who calls himself a CPA in a class. So I was confused by that. I'll do more research, because if people decide to do that and we try to roll this stuff and do some of this craziness, so then we'll need to, look at that. Okay. Yeah. So that's a really good question. So if people want to, move their inventory, see what the impact is, understand what the amended returns and all have to go, it needs to be worth something. But if it's $100,000, what I'm going to do is I'm going to make my numbers really, really round. I'm literally going to move back $125,000 or $90,000. Some number I'm going to push back exactly some number into a prior year. Try not to do some odd number. Yeah, the lifetime opportunity, I think it goes away. That lifetime opportunity goes away in 2021 or whatever. It didn't get renewed. 21, 22, that's going away. But the AOC list is good. But again, it's only good for 4 years. And the other one gave you a chance to get $500 or $600 on that other year that the kid was going in school. So that was one of the few things that wasn't good. Yeah, gifts. You have to call me on the gifts from the foreign countries. If they're not U.S., it's way too complicated. If they're not U.S. citizens, generally there's no limit. But that's way too complicated, because if they are, that's a different animal. All right. cannot change the accounting method. No, you don't go back to 17 and change the accounting method and 18 and change. No, you figure out this year that you're going to roll back an even 300 grand of that inventory, and you're just going to take it between your three partners clean as $100,000 K1, $100,000 K1, and $100,000 K1 adjustment. And then you're going to take that all back to 17 and get money in 17. So if you didn't know any taxes in 17, 17 is not a good year. But remember, the highest tax bracket in 17 was 39.6. So if you were in near that bracket, you were at the top bracket. So if you own a piece of property and you were in that bracket in 17, this is a good opportunity to roll a real nice, pretty number that says, guys, our PPP stuff was 300 grand. When we added it all up, it was $299, $312. We're just going to round it to 300 grand and go with it. Okay. And we've got some big clients that do 10, 13, 15 million, and they're basically accrual, and they've got big ARs. Well, if they went to cash basis, they get $1 million in AR, they're going to have no AR. Now they got 300 grand AP maybe, but that 700,000 net is going to go directly to the bottom line for some people. So really looking at all these businesses that are going on and what decisions they make in 2020 could have impact that goes backwards. And like I said, there's quite a few things in here. So yeah, to say that there's a lot would be an understatement. But anyway, we did perfect. An hour and a half, exactly what I wanted to plow. I'm not going to be able to explain all these without people are going to need their banks if they want to do these things. They're going to need my team to pull payroll and stuff like that. So if you guys need any of that stuff, then just reach out and we can help do that. Okay. Hey everyone, thanks for watching. If you enjoyed this video, please like, subscribe, and share it. To reach us for more information, please call 972-716-9919, or you can email us at tax@cpatexas.net. Thanks.